San Diego looks like a perfect sports city. It has a massive population, beautiful weather, strong tourism, and a loyal fan base that has supported teams for decades. Yet time after time, major professional franchises leave the city behind. From the NFL to the NBA and beyond, San Diego has developed a reputation as a city that cannot hold on to its teams. The reasons are often blamed on fans or stadiums, but the real explanation goes much deeper into economics, politics, and how modern sports leagues operate. San Diego is the second largest city in California and the eighth largest in the United States, with a current 2025 metropolitan population of approximately 3.37 million people. It ranks among the wealthiest regions in the country, driven by biotech, defense, tourism, and higher education. From a market size perspective, San Diego should be capable of supporting multiple major sports franchises. Television ratings for professional sports in the region have historically been strong, and attendance numbers were competitive during peak years. Despite this, teams have consistently struggled to secure long-term commitments. The problem has never been interest or passion. It has been the city's resistance to the financial demands of modern professional sports. The most visible example is the departure of the San Diego Chargers. The Chargers spent more than 56 years in the city and built a deeply loyal fan base. However, their home, Qualcomm Stadium, was outdated by league standards and lacked the luxury suites and commercial development owners now consider essential. The estimated cost of a new NFL stadium exceeded $1.5 billion, and public support for taxpayer funding was weak. When voters rejected stadium proposals, ownership interpreted it as a lack of commitment. In reality, it reflected a broader shift in how San Diego residents view public spending and private sports ownership. The Chargers owner, Dean Spanos, played a critical role in the outcome. Spanos sought a stadium deal heavily backed by public funds, similar to those secured in other NFL cities. When San Diego resisted, Los Angeles emerged as a more lucrative alternative. The move to LA immediately increased the franchise's valuation by hundreds of millions of dollars, regardless of attendance struggles. By late 2025, the Los Angeles Chargers reached a valuation of approximately $6 billion, highlighting a harsh reality for San Diego. In modern sports, market leverage often matters more than fan loyalty. Owners follow valuation growth, not emotional attachment. San Diego's challenges extend beyond the NFL. The city previously lost the San Diego Clippers, who relocated to Los Angeles in 1984 without official NBA approval at the time. The NBA franchise struggled with arena limitations, low media exposure, and ownership instability. At the time, San Diego lacked the corporate sponsorship depth and regional television reach needed to compete with larger markets. The league showed little resistance to the move after a settled lawsuit, reinforcing a pattern where San Diego was seen as a secondary market rather than a long-term investment. Once again, the issue was not attendance alone, but the city's inability to meet the league's evolving economic expectations. A major underlying factor is San Diego's political and cultural environment. Voters consistently oppose large public subsidies for privately owned stadiums. Ballot measures requiring supermajority approval for such projects make funding extremely difficult. While this protects taxpayers, it places San Diego at a disadvantage compared to cities willing to invest public money. Modern stadiums are no longer just sports venues. They are real estate projects designed to generate billions through surrounding development. San Diego's coastal geography, zoning restrictions, and environmental regulations limit this kind of large-scale expansion, reducing the city's appeal to profit-driven ownership groups. Media market size also plays a role. San Diego currently ranks as the 30th largest US television market for the 2025 to 2026 season, limiting the value of local broadcast deals compared to elite markets. Professional leagues rely heavily on media revenue, and cities with larger regional reach offer higher long-term returns. Los Angeles, just a short drive away, dominates Southern California's sports media landscape. This proximity creates competition San Diego cannot win. Sponsors, networks, and advertisers naturally gravitate toward the larger market, leaving San Diego with less leverage during negotiations with leagues and team owners. Tourism, while a strength, also presents challenges. San Diego's economy relies heavily on visitors rather than permanent residents. Sports leagues prefer cities with dense, year-round local fan bases that guarantee season ticket sales and consistent viewership. Tourism-driven attendance can fluctuate with economic conditions, making revenue less predictable. owners prioritize stability, especially as franchise valuations climb into the billions. San Diego's appeal as a lifestyle city does not always translate into the financial certainty professional leagues demand. The rise in franchise valuations has further widened the gap. In late 2025, top NFL and NBA teams are now worth between $6 billion and $13 billion, creating pressure for cities to deliver massive financial incentives. San Diego has repeatedly signaled that it will not compete in bidding wars fueled by public funding. While this stance is fiscally responsible, it effectively removes the city from serious consideration when leagues evaluate relocation or expansion opportunities. Teams do not leave San Diego because it fails. They leave because it refuses to overpay. The success of the San Diego Padres provides a confusing contradiction to the city's narrative of loss. Unlike the Chargers or Clippers, the Padres have thrived by doing the exact opposite, leaning into local identity and investing in downtown integration. Petco Park, widely considered one of the best stadiums in Major League Baseball, serves as the gold standard for how a sports venue can anchor urban redevelopment without alienating taxpayers. In the 2024 and 2025 seasons, the Padres consistently ranked among the league's top teams in attendance, proving that San Diego fans will support a franchise that demonstrates a genuine long-term commitment to the community. This contrast suggests that teams didn't leave because San Diego is a bad sports town, but because those specific owners failed to replicate the collaborative, investment-heavy model that has made the Padres a cornerstone of the city's modern identity. Despite losing teams, San Diego remains profitable for leagues. Residents continue to watch games, buy merchandise, and support national broadcasts without hosting a franchise. From a league perspective, the city still contributes revenue without requiring infrastructure investment. This makes San Diego valuable but expendable. It can be monetized without being prioritized. That reality explains why leagues express sympathy after relocations, but rarely act to reverse them. San Diego's history of losing teams is not a story of neglect or weak fandom. It is the result of a fundamental mismatch between local values and modern professional sports economics. The city prioritizes public accountability, controlled development, and long-term fiscal responsibility. Major sports leagues prioritize scale, media reach, and profit maximization. Until those priorities align, San Diego will continue to be a city that supports teams passionately, only to watch them leave when financial demands escalate beyond what residents are willing to accept. San Diego does not lose teams because it lacks passion or support. It loses them because it refuses to play the financial game modern sports require. In an era where franchises chase valuations over loyalty, San Diego stands apart. The result is a city that loves sports deeply, yet repeatedly pays the price for putting community interests ahead of billion-dollar business models.